Welcome to the D-Risk Weekly Global Markets Brief. It is Saturday, June 13th, 2026. 6 months ago, we tracked the fiat fracture, where capital fled paper money for hard assets. Today, the narrative has violently reversed. The theme of the week is the Peace Dividend Paradox. We are witnessing a massive repricing of geopolitical risk as hopes for a U.S. Iran peace deal ripple across the globe. But this relief rally is colliding head-on with a hawkish reality. Central banks are hiking rates into a slowing global economy, creating severe crosscurrents. The biggest dislocation is in the commodities complex. Oil and gold are breaking down technically, completely decoupling from the risk-on sentiment we see in equities. Investors are dumping inflation hedges, yet core inflation remains stubbornly high. The Bank of Japan is preparing its highest interest rates in decades, while the European Central Bank just delivered a hike. Yet, equity volatility is collapsing. Are markets correctly pricing in a geopolitical de-escalation, or are they ignoring the structural inflation that central banks are actively fighting? Alex, let's start with the international picture, Asia and Europe.
Thanks, Sarah. The international data perfectly illustrates this paradox. We are seeing regional equities absorb hawkish central bank policy even as localized economic friction increases. Starting in Asia, the Nikkei 225 consolidated, easing 0.85% on the week to close at 66,020. The market is bracing for the Bank of Japan to hike rates to 1.00%, which would be a 31-year high. Despite this impending tightening, the long-term technical structure remains robust. The Nikkei retains a golden cross, with the 50-day moving average at 60,863 sitting well above the 200-day at 52,900. In China, the Hang Seng Index edged down 0.98% to close at 24,718. The narrative here is dominated by sluggish domestic consumption and rising global trade tensions over massive Chinese industrial subsidies. Technically, the Hang Seng has confirmed a death cross. The 50-day moving average at 25,675 has crossed below the 200-day at 26,010, and a price remains suppressed below both levels, signaling sustained bearish momentum. Moving to Europe, the UK's FTSE 100 rallied 1.00% to close at 10,472. This strength comes despite news that the UK economy contracted by 0.1% in April. Markets are looking past the contraction, expecting the Bank of England to hold rates steady at 3.75%. The technicals support the bullish price action. The FTSE 100 maintains a golden cross, with the 50-day at 10,400 leading the 200-day at 9,992. Finally, Germany's DAX consolidated, dipping 0.50% to finish at 24,635. The European Central Bank just delivered a hawkish 25 basis point hike to 2.25%, citing inflation pressures from energy shocks. Yet the DAX is holding its ground as the German government pushes major structural reforms to save its industrial sector. The index preserves its golden cross, with the 50-day at 24,362 above the 200-day at 24,182. Sarah, international equities are showing remarkable resilience in the face of tightening monetary conditions.
That resilience is the defining feature of the international landscape right now, Alex. Despite the ECB hiking and the BOJ preparing for a historic move, European and Japanese equities are holding their technical ground. But this brings us to the core of our paradox. If global central banks are maintaining a hawkish grip to fight sticky inflation, how are U.S. markets digesting the sudden shift in geopolitical risk? Is the U.S. following the same resilient pattern, or are we seeing a decoupling across asset classes? Alex, break down the U.S. and cross-asset signals.
The U.S. is experiencing a profound cross-asset decoupling, Sarah. Equities are buying the peace narrative, while commodities are suffering a severe technical breakdown. Let's look at U.S. equities. S&P 500 futures consolidated with an upward bias, edging up 0.53% to close at 7,435. The Nasdaq 100 futures followed suit, edging up 0.67% to close at 29,662. The equity complex is treating the potential U.S. Iran peace deal as a pure relief rally, ignoring the broader interest rate environment and focusing entirely on the geopolitical de-escalation. In the plumbing, the 10-year Treasury yield closed at 4.49%. While specific weekly data for the 2-year Treasury was not available for the session, the elevated 10-year yield implies that bond markets are still pricing in a higher-for-longer inflation reality. This brings us to the U.S. dollar index. The DXY drifted down 0.32% this week to close at 99.75. The technical posture remains bullish, with a golden cross as the 50-day moving average at 98.90 sits above the 200-day at 98.64. However, there is a glaring fundamental contradiction here. U.S. CPI came in hot at 4.2%, yet the dollar is slipping on perceived dovishness from the Fed and shifting Middle East dynamics. The DXY is currently facing heavy resistance, and its inability to break out suggests traders are hesitant to buy the inflation data. The real shockwaves, however, hit the commodities complex. Crude oil plunged 6.25% to close at 85. This aggressive sell-off is entirely driven by optimism surrounding the U.S. Iran peace deal, which was overshadowing OPEC production cuts. Technically, oil presents a dangerous divergence. While a golden cross remains technically active, the price has broken significantly below the 50-day moving average at 97, though it is holding above the 200-day at 73. This is a clear breakdown condition, not a bullish confirmation. Gold suffered a similar fate, sliding 2.82% to close at 4,215. The precious metal is being hammered by rate hike fears ahead of the upcoming Fed meeting. The technical damage here is severe. Gold technically retains a golden cross, but the price has broken significantly below both the 50-day moving average at 4,588 and the 200-day at 4,420. We must note this explicitly. A golden cross with price below both averages is a major breakdown condition. Investors are liquidating their inflation hedges in the short term. Finally, the volatility index plunged 9.05% to close at 17.68. This contraction in the VIX signals that equity investors are fully embracing a risk-on regime, completely dismissing the hawkish signals from the bond market and the carnage in commodities. Sarah, back to you.
Thanks, Alex. That divergence in gold is the most critical signal of the week. When you see a structural breakdown in the ultimate safe haven asset, even as core inflation prints at 4.2%, it implies that the market is aggressively betting on the Fed to engineer a perfect soft landing, bolstered by a geopolitical peace dividend. Looking ahead, we are entering a massive week for central bank policy, which will put this peace dividend paradox to the ultimate test. The Bank of Japan is set to deliver its interest rate decision, potentially marking a historic shift in global liquidity. We will also hear from ECB President Lagarde and monitor crucial UK CPI and US retail sales data. But the undisputed main event is the Federal Reserve's interest rate decision and the press conference with Chair Kevin Warsh. Markets will scrutinize every word from Chair Warsh to see if the Fed validates the dovish hopes currently priced into the dollar, or if they reinforce the hawkish reality reflected in the 10-year yield. If the Fed leans hawkish, that breakdown in gold could accelerate, and the complacency in the VIX might vanish overnight. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.